How are things looking for the rest of the year, even for this entire emerging market space? Investment guru Marc Faber joins in to talk a little bit about that. Marc, good morning. It's been a tough start to the year for emerging markets. What do you expect 2008 to show up for us as a performance?
Well, I think that in general markets will not perform particularly well, whereby bear markets are characterized by strong rallies from time to time. So I think that we can get oversold sometimes in the next few months and then have a rally. But I think that new highs are pretty much out of the question. And I think that will eventually be lower everywhere than what we are now in emerging markets.
You would say that from what you have seen, there are signs of a bear market developing across many equity markets?
Well, I think what we had so far is actually a relatively minor decline. We've been going down on the S&P in the U.S. by about 20%, and in emerging markets we're also down something like 20%. But the difference is that the S&P, when it went down 20%, hadn't gone up all that much, whereas emerging markets, they are essentially way overbought and way over their long-term trend lines. So I think that in many cases, some of the emerging markets could still drop 30-40% from the present level.
That would include India, I imagine. What do you think will be the catalyst for this deep correction, Marc, that will take it so much lower?
Well, I think that markets move up and down, and sometimes it doesn't take much of a catalyst to make them move down. But in general, what we had in the period 2001 to 2007 is ultra-expansionary monetary policies in the United States that led to very strong credit growth, responsible for that. And this we shouldn't forget, was the Federal Reserve's irresponsible monetary policies. And so during the credit expansion, leverage increases and asset prices go up and risk appetite increases, and it drives all asset prices. In particular, what also happened is that current account deficit in the U.S. was growing very rapidly and created the so-called excess liquidity in the world, from which all asset markets, including commodities, real estate, stocks, benefited. And now, because of essentially slower credit growth, and in some sectors even a credit contraction, we have the opposite. We have a process of tightening lending standards and of deleveraging. And that leads in general to lower asset prices, although the Fed is doing its best to essentially create money, to print money, which is the cause of the problem in the first place. But the Fed is out of its mind. They try to solve the problems with money, which created the problem in the first place. But I think the private sector is essentially tightening lending standards and reducing risk appetite, and that leads to essentially lower markets.
There are some who argue, Marc, that in a situation that is developing in the U.S. that you alluded to, and with the Fed cutting rates, there's probably more safety or less risk in investing in an emerging market that is still holding its growth levels. How would you react to that argument?
I think this is a total misconception. In general, emerging economies have, of course, faster growth rates if we look out 5, 10 years and so forth. But the markets can be very volatile, and they correlate closely with the S&P, certainly in the last couple of years. And I think that if you look at India, we went from an index of 3,000 to 21,000 between 2003 and this January. I mean, we can easily have a 40% correction from the 21,000 level, or even 50% correction. And that would not necessarily mean that the long-term upward trend in Indian equities is disturbed. You can easily have 50% corrections in bull markets, but to sit there and to say, well, the U.S. has problems and we don't have any problems is just ridiculous.
The other facet of what's happened across asset classes, Mark, is that commodities have had a very big run, whether it's crude or gold. Do you think for 2008 this will be generally the best asset class or the highest outperforming asset class?
Well, in general, I think that gold is still attractive. I don't think it's terribly overvalued. And if you have a money printer like Mr. Bernanke at the Fed, who really doesn't understand anything about economics, who essentially just prints money whenever there is a problem, of course that lowers the value of paper money against, say, money that cannot be multiplied as easily, and the gold supply is limited. And so obviously the dollar goes down against gold, or if you turn it around, you can say gold goes up against the dollar. But in general, I think that precious metals are still relatively attractive, but the gold is now also overbought and is probably due at some point for a correction.
At these levels and these prices, for now, emerging markets would be an avoid for you, Mark, or would you look at some of them selectively?
Actually, I mentioned a while ago that the Indian market had formed kind of a wedge between November 2007 and January 2008, and then it broke out on the upside above 20,000 to 21,000. But the minute it broke down below 20,000 was a perfect sell signal, because usually when you have a false upside breakout, the reaction on the downside will be very strong. And I think in India we could easily revisit around 14,000 first, and then probably eventually even between 10 and 12,000 on the index.
On that optimistic note, Mark, thanks very much for joining us this morning.